Kindly be seated. With this, ladies and gentlemen, now we begin our next session of seasoned dialogue. Rethinking Markets, Dr. Gursharan Dhanjal, Vice Chairman, SKOCH Group, would be in conversation with Mr. UK Sinha, former Chairman, SEBI. I request both gentlemen to kindly be on the stage for this session. Dr. Gursharan Dhanjal, Vice Chairman, SKOCH Group, and Mr. UK Sinha ji, former Chairman, SEBI. I request both of them to kindly be on the stage. Ladies and gentlemen, Mr. UK Sinha is the former chairman SEBI, IAS of 1976 batch, and he was earlier Joint Secretary Banking and Capital Markets in the Ministry of Finance. As chairman SEBI, he brought about quite a lot of bit of reforms, including oversight of commodity markets and collective investment schemes, a votary of innovation even at the regulatory level. During Mr. Sinha's tenure, the SEBI's responsibilities grew considerably. He also chaired the expert committee constituted by RBI to propose long-term solutions for the economic and financial stability of the MSME sector. Ladies and gentlemen, this conversation would revolve around the theme of rethinking markets and includes how to make Indian market more vibrant, safe, and even more competitive. Now I request Dhanjal sir to kindly begin.
Thank you. Can I request silence at the back of the hall, please? Well, thank you so much. Thank you very much, sir, for joining us this afternoon for this interesting discussion on rethinking markets. Hardly anyone I find who doesn't find interest in markets. But there are very few people who actually understand how these markets have become vibrant. How is it that the Indian capital markets have become one of the fastest in the world? Put together, we are today 8th largest capital markets in the country. The largest, the exchanges that we have, which is Bombay Stock Exchange and the National Stock Exchange, put together their market cap runs into about $6 to $7 billion. New York Stock Exchange being the largest at 25 billion, followed by Dow Jones and many others. But India starting small and becoming big has been a great achievement for us. So Indian markets have become vibrant over last few years and have also brought in equally important or otherwise, the staring challenges. And it so appears that when we talk about India 2047, we may be, 4 trillion in terms of the entire capital market, the market cap in India, which is poised to be 60 trillion over the next 25 years during this Amrit Kal, provided things as they have been put on the roadmap are achieved by and we continue to reform and continue to grow. The very first thing there, is that while we are maturing in terms of the capital markets, we need to rethink because it has become kind of concentrated. There are not more than 2 or 3 commodity exchanges. There are only 2 national exchanges. The competition has been such that each state in India used to have its own stock exchange. That number has now today reduced to 0 because they all became insolvent. But that has got concentrated towards the Bombay Stock Exchange and the National Stock Exchange and a couple of commodity exchanges. So, sir, my very first question to you is that while markets are becoming vibrant, how this vibrancy may not become a threat to us that we need to de-risk, and in order to make it competitive, do we need to spread it? Meaning to say, more exchanges are required.
Thank you very much for inviting me. On the question, I begin with this question on the stock exchanges. If we all look at it from the historical perspective, the best example to look is in the United Kingdom. In the early part of the 20th century, when trade and commerce started growing there, different centers in the United Kingdom became specialist stock exchanges for a particular commodity. Steel and coal, there was one exchange. For woolen clothes, another one. For garments, another one. And the whole idea was that the investing public is not aware of the credentials of the promoters, or they are not aware about the company. So make them localized so that people from that center will know how the promoters are, and then they will take a call. So this was the starting point. To some extent, this was also true for the United States. But it is a sign of the maturity of the markets, both in UK and in India, that now we have national level exchanges. In fact, in a lighter vein, when people ask me what was my biggest challenge and biggest achievement as chairman of SEBI, then the first thing I say in a lighter vein that I have the distinction of having closed down 21 regional stock exchanges. So I closed down 21 regional stock exchanges. And why? Because the whole philosophy has changed with the reforms and coming in of SEBI is that the information about a company has to be uniformly available to everybody in the country, wherever he is located. And the trading center which are there now, whether you are based in Guwahati or you are based in Jalandhar or you are in Mumbai, you have the same information and your trading has to be at the same speed and at the same time. So let us first understand that this is a sign of the maturity of the Indian market system. That we have now national level exchanges, and we have to be proud of the fact that India as a market infrastructure has several firsts to its credit, which even in other parts of the world has not been possible. For example, when the trading happens in India today, and let us call it the day T, then the settlement can happen on T+2. That means 2 days after that. Some of you who are aware of the old system, it used to take a month. And even then there was no certainty because there was something called badla, so it could be passed over. So friends, the first thing is that the regulatory architecture has matured. The number of investors and the type of investors has also matured. So I would like to say that the level of development in the Indian market is comparable to the best in the world. I'm not saying that further reforms are not required, but my starting position is that we have done a lot, and we can be reasonably proud of that.
I fully agree with you because going back only a couple of decades, as you rightly mentioned, everything was paper-based trading. Everything was ring-based. And the language sign and the hand signs were used as a language, and the shouting and all those kind of things used to happen. Gone are the days. This has actually led to, cut to today, this has actually led to democratization of equity. And what we call democratization of capital. So, the smaller towns, category B and category C, they are able to participate in equity and so on and so forth, which earlier possibly was not the case. There were cases of bad delivery and NSDL and CCIL. I mean, the entire landscape has been changed. From T+15, T+30, now we are talking about the same day, the T+0.
T+0.
And I mean, having come such a long way, so why did we not think of creating more such exchanges, and why have we remained concentrated in two? Is it because of the regulatory environment, or the competition was not such that it required more exchanges to exist?
I'm not too worried about whether there are 2 exchanges or 3 exchanges in the country. The important thing is how are they functioning. And starting a stock exchange is not a very easy thing. If you go outside the country, even in developed markets, you will not find that new stock exchanges are being opened every day. It requires a lot of capital, lot of technology, and also because of the interconnectedness, many of the trading venues are facing the problem that people sitting outside that jurisdiction can also trade and take advantage of that. London Stock Exchange today, for example, is facing a serious existential crisis. And after Brexit, they are actually facing a crisis. So I would say that we should try and measure how the exchanges are doing. Are investors' grievances being met in time? Are trading and settlement happening in time? Does the clearing corporation have enough money to settle a particular trade if anything is happening or any large fluctuation happens in the market? So it is the question of administration and governance of the exchange which has been the main focus of SEBI, rather than how many exchanges are there. However, by law, subject to certain conditions, you can open a new exchange. There is no prohibition. And in fact, the policy is, there was a debate during my time, that why should we have 2 or 3 exchanges? We should have only one exchange. And we canceled that idea. We didn't accept that idea. We said, no, certain amount of competition and doing away with monopoly is required. So I would say that today there are 3 exchanges which are functional. The volumes may be different, but they are functional.
You have been a big votary of innovation, right? Right from your days of SEBI. And even today you talk about the same thing, that in order to continue to progress and compete, we have to have innovation. Similar innovation is required even at the regulator level. How has that evolved over a period of time? Has the regulator evolved? Has the regulator innovated along with the industry? Or given the strict compliance regulatory environment, there would be a resistance, and while everything else on the landscape has changed, the innovation has taken the backseat?
I would like to tell the audience here that SEBI is a very strange animal. We all know that in our constitution there is separation of judicial powers, administrative, executive powers, and the legislative powers. SEBI is one institution where all the 3 powers are there combined in it. So it has got all the 3 powers. And even the Supreme Court has said that given the situation of the market, it is required. So the first point is that it's a very powerful organization. And because it is so powerful, your point is valid, that continuous rethinking, continuous innovation, continuous changes are required. Has it happened? My view is not to the desired level. And what should be done? I have 2-3 comments to make. I would like to draw the attention of the participants here that there was a committee chaired by Justice, it's called the Financial Sector Law Reforms Committee. A retired Supreme Court judge chaired that committee. And one of the things he mentioned very categorically there is Justice Sri Krishna, Justice B.N. Sri Krishna, that the law-making power or regulation-making power of the regulator has to be through a particular process of consultation. In my view, and the feedback that I am getting from the market participants, this is an area of improvement for all the regulators, RBI, SEBI, IRDA, all of them. They should improve, because by being in a haste or doing things which they think is right, they are not able to take into account at times, not always, at times, the problems of the market, and then mistakes happen, and then remedial measures have to be taken. So first point is consultation, and second is regulatory capacity. Rightly, it has been mentioned about innovation. If you are a closed organization, howsoever talented people you have and howsoever advanced technology you have, you are dealing with the rest of the world. Your organization versus the rest of the world. So unless there is openness and willingness to see what is happening outside, you cannot be a relevant organization. You will be creating problems for the market and problems for the economy. So this is another area where further improvement is required. That is the capacity, the regulatory capacity. I mean, there are people who will argue that compared to last 10 years or 15 years, a lot of improvement has happened. Fine, it has happened. I'm not doubting that. But we have to go far, far ahead in this area. And the message that has to be given to the market is that we are willing to do that. I think this is an area of improvement.
Now we also have Gift City in front of us, and you know there are entities which are listing on Gift. So, in your opinion, to what extent is it really going to be accelerating the process of having to achieve the Atmanirbhar targets of 2047 for India to become a developed country? Because given the kind of growth that we have in the capital markets, they are going to be growing faster than expected. How is GIFT going to complement that?
I'll talk about GIFT, but let me add something on the previous question. I want all of you to appreciate that over the last 20 years, the Indian market has matured a lot. I'll give you one or two data points. If you look at the mutual fund industry 10 years back and now, the total assets under management is around 6 times. The size is about 50 lakh crore, $600 billion. 10 years back, it was 1/6 of that. And the good part is that 10 years back, equity component of the market was hardly 21 or 22%. Today it is 56%. More than 16 crore people are having mutual fund accounts. SIPs, systematic investment plan money, is now coming more and more from smaller towns. There is a concept in SEBI called top 30 and below 30. So the towns which are below the top 30, from there, the inflows are more, which means whose money is it coming? A small employee in a private or government organization, a small shopkeeper, a teacher, their money is coming into the market. So our market has become, like you use the word democratization of the market, that has happened. And we should be conscious of it. I'm not saying that this is enough and no further progress is required. But this is something which is happening. And the assets which have grown, now one important thing, and some of you might have noticed if you watch any roadside hoarding or if you want a cricket match, you must have noticed that now advertisements are coming of mutual funds. So mutual funds, sahi hai, for example, there is one tagline. So those things are now reaching the mindset of ordinary citizens of this country. So that maturity has happened. Now coming back to Gift City, you see, National Stock Exchange was created in '93. And it took about 10 or 15 years for that whole organization to make a real impact on the Indian market. They brought out some fantastic new ideas. The ownership was different. The way trading was happening from terminals all across the country, these were very, very novel ideas. Similarly, Gift City is, or technically it is called International Financial Services Center. 2-3 things we have to appreciate. One is, what is the seriousness of the government about it? And the seriousness of the government is very, very strong. Let me begin with the tax issues first. If there is a foreign investor, or let us technically call it a non-resident investor, he doesn't have to pay long-term capital gains tax if he is a sovereign wealth fund or a pension fund. No long-term capital gains tax, no dividend tax, no tax on interest earned by him. If you are a domestic person and getting registered in GIFT City, then you pay only a concessional amount of tax. The tax rate is much lower. Another important thing, there is something called FIF, Family Instituted Firms. What it means is that you can set up an FIF and your own money you can invest there, and from there you can invest it in any part of the country, no questions are asked, and there are no tax implications. In my view, we will see some quick results, maybe next 1 or 2 years, in 3 areas. One is bullion trading. So the international bullion exchange which has been opened in GIFT City, that has already got about 2,000 kilograms of gold trading. It is already happening in one single day. More importantly, yesterday, 9th of February, Reserve Bank of India has come out with a notification permitting Indian banks to act as a clearing member or as a trading member on the international bullion exchange. So of the 3 things which according to me will happen faster and we will see quick results, one is bullion trading. Second is this connect between Singapore Stock Exchange and National Stock Exchange. So that has already started trading. And third area, according to my understanding, is the area of leasing. So aircraft leasing, area of ship or ship equipment leasing. These are areas where I would hope that some progress will be seen in the GIFT City. But GIFT City becoming a very important area in competition with NSE or BSE, that will take some more time. But I think we are on right direction.
In fact, when we talk about democratization of capital, we also see that there are more products which need to be listed on the exchange. Products in the sense that like mutual funds and stuff like that. And there has always been a need for that. But it has taken almost like 20-25 years now with the National Stock Exchange since 1993 has been in existence. And Bombay Stock Exchange for almost like more than 100 years.
Yes.
And still there is paucity of products. So what needs to be done so that the portfolio of the exchanges become wider?
You see, the participants in the market or the beneficiaries in the market should be broadly categorized into 2 different categories. One is a small Indian investor. You and I, about 20 years back or 30 years back, where did we invest our savings? It used to go in government bonds or it used to go into bank fixed deposit. And government was taking that money and giving you a certain assured return, and that was all. If you are a government employee or organized sector employee, you had provident fund and money was going there. For you and me, a very sophisticated product is not required. For us, it is required that whatever product is being offered or sold, there are good laws governing the trading, there are good laws about settlement, and my money should be safe. I think on that part, we have done reasonably well in this country. Although, I'll give you a rider that redressal of individual grievances is again an area of improvement. And I hear stories from people that they wrote to X authority or Y authority, and for months together, there is no redressal. So that is an area of improvement, when by and large we have made progress. The second part is where sophisticated products are being offered. And those products are mainly required for very large investors, very sophisticated investors, and for institutions. There, our approach has been in this country to be a little cautious. And I'll come back to this question of innovation. My view has been that if there is some new innovation coming in and the regulator or the government authorities of that day are not able to understand it, and they are being asked to do it only because some other country is doing it, or we are convinced as authorities that these are not in the best interest of this country at that particular stage, then it should not be allowed. Because the tolerance level for failure in our country is very low, very, very low. So a conservative approach, in my view, in these matters is better. But I'm not arguing that we should not allow anything. We should evaluate as a country. And some of these sophisticated products which are being sold in other parts of the world, they also have their stories. Some of them have led to serious problems. Some of them have been very successful, but some of these have led to problems as well. In my view, we should concentrate more and be very mindful and sensitive about the large population of this country which is putting their hard-earned savings into the market. Sophistication part is required, very much required, but it has to be done with caution.
You rightly said that it has to be done with caution. I mean, only if I go back to the house and ask everyone that how many of you are actually exposed with your investments in the equity market. So let's see the hands going up. So how many of you? 1, 2, 3, 4, 5, 6, 7. Not more than 12. So out of a house full of more than 100 people who are all educated, who all are at a senior position, they have not actually dared even to venture into that.
Can you also do a poll of how many of them are mutual fund investors?
Okay, let's see the hands going up. Yeah, so there you have a substantial number, nearly 25 of them. So that means to say that while Indian investor is veering towards that, but it still requires a whole lot of investor awareness and investment protection, which is what we just talked about. And given that, the confidence level still has not reached to that level, wherein to go in for the sophisticated products, like the way you talked about bonds. The green bonds, India is number 3. How many of us know that actually we do have green bonds to invest? After China and South Korea, we are number 3 worldwide. And now with the ESG bonds coming in, there is a huge opportunity to leverage that, because that is something which is also going to be adding a lot of value, both shareholder and investment and investor value to the Indian corporates. So, what's your take on this? How do we leverage?
I'll first try to handle this issue regarding green bonds or ESG. In my judgment, the whole environmental, social and governance issue or climate-related issue has encountered a serious setback in the last 2 years. We are in the month of February 2024, and the Ukraine war started in February 2022. So last 2 years have been a serious setback. Prior to that, and there are dozens of examples and matrices to show that how we were making progress. What has happened that after that war, and let me go back, that during the COVID period, everybody realized that focus on environment is required. But it has undergone a serious change after the war, because everybody wants to protect their energy security, everybody wants to ensure that they should not face a problem in the winter and things like that. So you will be surprised to see that in the United States, that's the best example for that, there are certain state governments which have banned, they have put a ban on funds using ESG criteria for making investments. So there has been a complete reversal. Texas, South Carolina, and there is one more. There are 3 states which have passed law. So if you are a BlackRock, for example, and you apply the ESG criteria in your investment, then the state will not allow you to work in that particular state, and state pension funds will not contribute to your corpus. So there is a huge setback in that. So let us keep that in mind. In my view, it is a temporary development. This cannot go on because this war, after all, has got to end one day. People have to start thinking long term rather than short term. Keeping that in mind, the initiatives like the green bonds, initiative like the social stock exchanges, which all came, the ideas came in a big way in 2021, 2020, but they have got a setback. But their time will come. I'm sure their time will come. And on the question that why green bonds are not progressing, the point is, if all of us sitting in this room, we are very, very conscious of the climate issues, and we want to make investment in that green bond, we are also expecting a certain return. And at what price that bond is being raised, and where it is being invested, and are they making that extra return and all. So these are matters which will take some more time. I'm not disheartened. This is a temporary setback. Maybe, hopefully, next year when we have this discussion, things will be brighter.
Yeah, actually so. Going back to the regulator, do you think there is a need for an independent assessment or evaluation on the effectiveness of the regulator, or also at the same time to make suggestions how it can perform better?
Yes, you have raised a very, very important question. And unfortunately, in India and in many other parts of the world, but more in India, the accountability and evaluation of regulators is not a high priority. There are informal methods. If something goes wrong, a phone call goes from somewhere to somewhere and things are set right. But for you and I as citizens of this country, how are we assured that there is accountability, and what is the right accountability? I'm of the view that a regulator has to function independently, which means it should not be accountable to the government of the day. Because today, if I'm accountable to A government and tomorrow there is a B government, then there is a serious problem. And as a regulator, I should not be carrying out the political programs of the government in power. So it should not be the government of the day. It should be the parliament. Parliament has a mechanism. There is a committee on subordinate legislation which can look into these matters in great detail. Unfortunately, that is not happening in this country. And I have written about it in my book. I have written a book called Going Public. I have written about it, that how the accountability should be fixed. Second is judiciary. Judiciary is a good checking point for ensuring accountability. And the third is the media. Media is also a very good means to put the regulator on an edge and ask questions. But the point is, there should be a mechanism that the regulator is obliged to answer this question. Even Justice Sri Krishna Commission has looked into the issue of accountability, and that is why they have said that the regulation making should follow a process. They should ask for public comments. The public comments should be discussed, and why the regulator has accepted or not accepted a particular suggestion, that should also be listed and shown to public. So a very democratic way of regulation making. However, I concede your point that the level of accountability as it exists in India today is low, and it needs improvement. There are 3-4 methods that I have mentioned just now, how to do it, but as of now, it is low.
You also had said once, I remember, that a time comes when innovation is ready, but the regulator is not. So has the time come?
I think market is also always ahead of the regulator. And I also feel that is the way it should be. The catching up has to be done by the regulator. Unfortunately, when they refuse to do that, there is a serious problem. There is a serious crisis. Some of the new products which have been launched in the last 10 years or 15 years, many of these products have not got any large volume. But these were products which were required. The derivative trading in India, for example, the first 8, 9 years, 7 years, there was hardly any activity in those products. But now those products are at least volume-wise the biggest in the world, and they are providing a certain amount of counterbalance and check on the market. So regulators have to catch up. The innovators are smart people, and their universe is very large, and that is the way it should be.
Well, that was quite interesting. In fact, when we talk about the Indian markets, there is always two sides of the coin. People stay away from the markets assuming that this is gamble. But, actually this is a major contributor to the national economy and the GDP. And, this is all the time that we have on this positive note that, we need to continue to evolve, whether it is in terms of the regulator or any other department or for the government, because innovation is part of our life. And very true that innovation will always be ahead of the regulation. And the regulation, important point is regulation has to catch up. I mean, if it does not, then we have a problem. But so far that has not been the case. In terms of SEBI, whatever, because you have to compete with the global markets, and they are much faster and much ahead and much maturer. We do agree that Indian capital markets have matured, but this maturity is from infancy to maturity, but not from maturity to mature. So that is something which is going to come over a period of time. So that's the reason why we say for mutual funds, many hands went up, but for equity, they're as less as 10%. The reason for that is simple: fear. We do not want to trade a territory which historically, during our childhood days, since we've been witness to that, we do not want to jump into the ring and say we want to bet or gamble. But realizing little that, markets are much more mature, much more secure, almost on a real time, you are able to see as to where it is. The anxiety is out of that, and you have many products to leverage from, not just the regular day-to-day trading or equity markets. So there's a long way to go, but yes, we also have come a long way. Well, thank you very much, sir, for your comments and your inputs. I appreciate it a lot. Thank you.
Ladies and gentlemen, here we thank Mr.